again to Lisa for presenting her career story with us and to teach us a little bit more about financial fitness. So Lisa is a senior vice president at US Bank and is working with the wealth management group. Lisa has more than 30 years experience in the financial services industry. As a co-head of public markets due diligence, Lisa is responsible for directing all public markets investment research and fund manager selection for US Bank. This includes money manager due diligence, investment strategy review, and portfolio inclusion for equity, fixed income, real estate, and balanced strategies, amongst other things. I'm hoping Lisa can teach us a little bit more about what this all means, but it was nonetheless very impressive going through her experience. Lisa is also a frequent spokesperson on wealth management topics and has appeared multiple times on CNBC, Bloomberg TV, Yahoo Finance, and Fox Business. Lisa is passionate about her community and serves on boards such as the Women's Economic Roundtable of Minnesota. So welcome, Lisa. We're so happy that you could join us today.
Well, and thank you so much, Megan. It really is an honor to be here today, and I am just so much looking forward to the conversation. So let me give you a brief introduction of what I hope to cover with you today, and then as we're going along, please do store up any questions and answers, because at the end of the day, this session is only going to be a success if you get the information that you need, including any follow-on queries as far as things I didn't address, or maybe just more background information on the topics that I did bring up. So looking forward to that Q&A section. If you would go ahead and forward a slide, the specific things that I'm going to cover today really fall into two categories. So the first is that in working with your team here at Women in Biohealth, they mentioned that one thing that really would be helpful is just to talk a little bit about the financial and market situation today. Obviously, as we all think about how we want to manage risk, which I understand is a big theme for this year for you all, our finances is part of that, because our finances impact, how we support our family, our friends, the causes that we care about. So starting out really with the first part of the presentation in terms of where we are in terms of a market outlook, as well as what that means for both potential strengths and risks for where we may be headed. And then secondarily, the team also asked me to spend a little bit of time on my career journey and just things that I could share with you as far as learnings that I've had over time. So that really will be the second part of my presentation. Okay, well, if we move forward, let's just jump right into it on managing financial risk and where we really are in terms of the markets and the economy today. And there's really two big topics that I'm going to cover as I go through this. The first is just a brief recap of where we're coming into 2022 by recapping both what the outlook was last year as well as the last few years. And then, of course, the second big part of where we are really economically and financially today. And as we go through this, I want to just make two comments up front. Obviously, there's a lot of news, a lot of tragic news, obviously coming out of the Ukraine today with the Russian incursion into the Ukrainian space. And so while I'm not going to focus on what's going on with Ukraine, even as much as it is in the news, I will, as I go through some of the slides, touch on the potential implications of the conflict for, how that may affect the financial and economic outlook here in the US and also globally. The second thing is for those of you, and I suspect many of you are, who are really adept at looking at all the figures on charts and the dates. What you'll see is all of my charts are updated through the end of January. Our group updates these figures as well as additional charts once a month. So just having turned the corner on February, we're going to have the slides out soon, updated with another month in point. But for purposes of this presentation, since we just turned to March 1, I don't have all those charts updated. But again, I'll fill in the data as necessary for any updates on trends through the last month. So with that, if we could just dive in. The one thing I want to make up front as we think about what's happened in markets over the last year and the last few years, and even year to date, is that while certainly there's been a lot of volatility as we've experienced, different events from, again, the nervousness over what's going on with the ground war in Europe, with the onset of pandemic, with the discovery of vaccines, all of these very momentous events. The basic underlying factor that really we should keep in mind is while, again, we've had a lot of ups and downs, if you just look at this trend line here in the chart over the last several years, stock markets generally have been up. And what this particular line shows is that for the US stock market, as represented by the S&P 500, which is just a benchmark of larger, well-known companies. Again, you see some ups and downs, but again, over the period since 2017, what you've seen is the general trend has been up, and even very dramatically so if you sort of look at that bottom there in sort of the middle of the chart, shortly after we all realized the pandemic was upon us and the impact of that, we really had a quite incredible recovery. So, this is really the backdrop that we're going into 2022 against. Next page, please. All right, well, this chart then, as far as giving context for the last few years, breaks this down a little further. And what we've done here is we've focused on really essentially the last 3 years since 2019. So just before the pandemic started to today. And what we've done is we've shown the performance not only of the US stock market, which was featured in the prior chart, but we've featured a number of different investment types that you can be involved in. So let me just run through those from top to bottom there in the most left-hand column. So again, I mentioned the S&P 500, that's just a measure of large company US stocks. So just a general good indication of what's going on here in the US, what some people will call equity markets or stock markets. MSCI EAFE, which is the next row down, is also a measure of stock performance, but in this case of those of non-US, big non-US developed markets. So the markets in Europe, Italy, Germany, the big markets in Asia, Japan, Australia. So this particular benchmark totals up in general how those markets have been doing. The next line down, MSCI Emerging Markets, is another stock market measure, but in this case of more developing nations. So these would be nations like China, which again has really grown in its economic prowess, but again, relative to European markets or the US market, is still further behind in its economic development, has a lower per capita income. So again, emerging markets includes things like China, like Brazil, like India, those other kinds of markets that are moving up the economic curve, but not quite to developed nation status. The next one down is the Bloomberg Barclays Aggregate Bond Index. So this is a measure of how you would invest in more bond or loan type instruments where you invest money and you get paid a certain interest rate back by the borrower of that money. And then the next two are commodity indexes. So these are things that really touch upon things like hard assets that you can invest in, like oil. Obviously, we've all been watching the price of oil go up here the last few months, or they could be grains or like wheat, or it could be precious metals. So these two indices measure different takes of commodities that you could invest in. And then I'll wind up with the final two. REITs is just a measure of real estate. So if you invest in a diversified portfolio of securities that represent real estate, that's what the REIT index is. And then finally, cash, good old plain cash. Just if you have your money in cash, what is it done? So with that, what I want you to do is then skim the other columns to the right of that. And what you'll see is, again, since 2019 and 20 and 21, again, even though we had some very significant events occurred during those periods, what you'll see is that the returns across all those different asset types actually were generally pretty positive. I mean, not just positive, but in many cases, single digits, and in some cases, even very impressive, high double digits, like 20%, 30%. And again, there were some negatives. For example, if you look at 2020, one item that's going to particularly capture your eye is the performance of oil. 2020 was a very terrible year for oil because there was a lot of concern with the pandemic and people not really being able to be out and travel, that oil demand would really fall apart. And so, oil performed quite poorly as a commodity investment. But again, in general, we've had really very strong performance. So it's against that strong performance that now, in some ways, the 2022 year-to-date returns, while very short, again, this is only through January, but the trend has continued through February, where we're starting to actually see some negative returns on asset classes. So I think, again, the big question is, are we going to what's the expectation? Is it going to be a rougher year for investments or not? And what are sort of the factors behind that? So if you flip to the next page, this chart just puts that up and down performance of the past 3 years versus year to date in a little bit of context. And what we've done here is we've actually, again, just taken the S&P 500 as a common area where we all invest, again, US stocks, and just list out for a very long history since 1990, the annual return of the index. And you can see that in most years, it's not guaranteed, but in most years, stocks usually post a positive return. So again, if you're a long-term investor, if you're looking to save for retirement or some sort of longer-term goal, it really does make sense if you have the risk tolerance to put stocks in your portfolio. The other thing I want to make though as a point, and it's often easy to forget this, even myself, even though I'm tasked with on behalf of our clients following markets day to day, is while you see those very positive end of year numbers for the whole year for the S&P 500, if you look at those red numbers underneath, what you'll see is the intra-year, what we call drawdown, or the lowest point that the index hit during each of those years. And what you'll see is that while, again, in most years, the US stock market has ended up with a very positive return, in almost all years, there was a drawdown of anywhere often between 5% to 15%. So again, stocks don't go straight up. Markets do have bumps in the road. Concerns do come up and they'll fluctuate. But again, I think the point here is, just because we've gotten some interim volatility doesn't necessarily mean that, stocks will be down on the year. And also that, again, the longer term objective you have, really the idea is to try to focus on your long-term objectives and how you should be investing for that, as opposed to focusing on some of the near term noise. But nonetheless, I will give you next an update on where we are both economically and market-wise. So with that, let's move to the next page. What is our bottom line? I've been talking around it, giving this market context, but really, where are we in terms of our views on the economy and the market? And the best word for that is balanced. When we see, both the underlying strengths of what's going on economically and for companies and the markets, there are counterbalancing that a number of risk factors. So all other things being equal, and this isn't meant to give you specific advice for your portfolio, because that is, always done best in conjunction with your financial advisor, looking again at your specific goals, your time horizon, your risk tolerance. But all other things being equal, what we would suggest right now is that people take a more balanced view of their portfolio, meaning whatever you would normally allocate to those different asset classes, whether they're stocks, whether they're bonds, whether they're real estate, whether they're commodities, we would advocate staying close to a neutral position to that. So if normally your portfolio would be 50% in US stocks, we would advocate your base position right now being 50% in US stocks, as opposed to being more aggressive and being overweight, or more cautious and being underweight. So why is that? Let's move forward with the slides. What I'm going to first do is outline again some of the very positive things that we're seeing going on in the economy, and then again some of the risks that offset that and make us put us in more of a balanced position right now on the economy. This chart actually shows really how the US economy is performing today. And so what we do to come up with this chart is we take hundreds of indicators that measure consumer health, that measure manufacturing health, that measure all kinds of sectors within the US economy, and it plots them among two dimensions. So on the left to right dimension, or the x-axis, what it shows is the absolute reading of that particular indicator, and then the percent that are either to the right of that middle line, which means that they're above 50% for their particular measure, meaning that they're more in a growth mode, or the percent on the left hand side, which is meaning that they're below 50% of their historical range, and therefore are in more of a contraction mode. The y-axis, or the vertical axis, by contrast, measures the change month to month or quarter to quarter for a particular indicator. So what we do is we actually say not only where's the position right now, but are more of the indicators moving up month to month, like increasing in value and showing more growth, or are they contracting? Are they showing less value? And if you just take a look at where the most percentage of indicators fall, what you'll see is that actually the economy is on pretty solid ground right now. So again, if you focus on the percent of indicators to the right, meaning that they're in growth mode, we have over 60% of indicators in growth mode right now. What the top to bottom will tell you, though, is that while some of them are relatively more slowing, but it's from a higher base. So this is what gives us confidence that right now the US is in solid, sort of expansion mode. And while we're seeing some declines in sort of the rate of change of the indicator, or the growth of the indicators, again, most of them are still pointing to growth at this point. Next page, please. Okay, this is the same. Oh, sorry, just back one. This next one is the same, but for, non-US economies. So again, big economies outside the US, like Germany, like Japan, and it shows the exact same statistics. This is another reason why, again, we have a more balanced view, because when we look at those big non-US economies, what we're seeing is actually an even better picture than what we have in the US. And we're seeing, again, if you look at the percent on the right, 72%, again, in growth indication mode, and a decent percent above the horizontal axis, meaning they're actually still changing positively month over month or quarter over quarter. So again, the global economy tends to be on fairly good footing. Now, I mentioned I will throw in, some thoughts on, what might the Russian-Ukraine situation be indicating. There is a lot of concern, and we'll talk about this in future slides as well, is that there is going to be a net potential negative impact from, what's going on in the war there. And there's really two potential impacts from that. One is that, again, with some of the potential supply constraints because of that incursion, particularly on some of the commodities like energy and other big commodities that Ukraine and Russia produce. Some are metals, some are grain related, that again, as those supplies are constricted, that could further increase prices and inflation. And for those of us who utilize those exports, again, we would bear that cost in terms of higher prices. And in turn, that could, again, potentially slow growth as we have to move more of our incomes towards, again, some of those commodities. But I think in general, the thought right now is that those are on the margin. Again, we may see somewhat more of a hit, and that may shave some off growth and push up inflation to some extent. But again, we'll have to see where that goes. So that, again, amplifies some of the risk factors that I'll mention later. Next slide. Okay, this is just a final, and I realize I'm per my usual form, maybe giving a little bit extra explanation. So I'll try to make sure I keep moving through the slides. But this is another slide just to show, again, some of the underlying strength that it's easy to forget in the midst of all the news that's been going on. So these three lines with all their wiggles actually just show different reopening indicators, and often give us a more high frequency or week by week look at, how the economy is doing, how are people spending money. So that top line is TSA travelers, the number of people going through TSA checkpoints in airports. So again, gives us a sense of, how much people are getting out there, starting to resume travel. The next one is open seating table reservations. So again, how much are people getting out and dining? bottom one is same store sales. So it gives us a sense of, how retail is performing. And what it does is it shows it since just before I think the vaccines were announced in October of 2020, if we can, even think back then, to again through the end of January. And again, if you look at all three of those lines, what you'll see is we've had a pretty steady progression of healing in the economy. And despite the wiggles, the general trend is still up and people are still increasing their activity in all three of those areas. So again, another sign of continued healing of the economy. Next page, please. The final point I want to make with respect to the strength of the economy is how is that then actually translating into how companies are performing? So there's a lot of numbers, and I realize it's a little bit small on the page, but if you'll focus on those middle three columns, which say year over year growth for 2019 to 20, and then 21 to 20, and then forecasted for this year, and you look at that bottom blend number, which is just the average of many forecasts across different services, you'll see again a very positive economic picture. Obviously, in 2020, we had a tough year with the pandemic, with the lockdowns, and people not being able to conduct business in the way they would. So we actually had a negative year in terms of growth. But I think, as we all know, 2021 was a year of recovery. In fact, very strong recovery at 41% growth in earnings for, again, here, this is for the S&P 500 group of companies. And again, the forecast for this year is not that we're going to be able to duplicate that reopening and be at 47%, but it's still for very solid, respectable growth at 11%. And then if you look at the next three columns, which they call PE multiples, what this shows is the dollar that you're paying for a stock for every dollar of earnings that is being given to you. And what you'll see is that the way that stocks are priced right now, essentially what you're paying is about 19.9 times of the stock price for every dollar of earnings. And in the historical realm of PE multiples, that's actually a very reasonable figure. So these two factors, again, give us confidence in where we are market-wise right now. Next page, please. Briefly, what I'll say here, again, because I'm running a little bit long, is the other question that might come up is, fundamentally, how are these companies doing? Not just, are their earnings expected to be good, but, are they taking on too much debt? Can they cover their interest costs? And basically what these two charts say is, actually, from a financial standpoint, most companies are in very good shape. Next page. Okay, so that's all well and good, Lisa, but we started this whole chart slide and you talked about this year markets are down. So what is going on? Why are the markets in some ways concerned? And why do you yourself have a balanced outlook? And there are certainly risks on the horizon that are making us, again, more balanced in our outlook as opposed to more on the optimistic or glass half full side of the ledger. And the first and primary of those is really shown here on this chart, which is the fact that we're really moving from an environment of accommodation by both, what Congress is voting in as far as fiscal support in terms of, stimulus checks, those kinds of things, as well as monetary support from the Federal Reserve. So let me take a step back and explain what I mean by monetary support. Monetary support is really controlled by our central bank, the Federal Reserve, and what they do is they control the level of interest rates that are behind, when we borrow for a house, when we borrow on a credit card, when companies can borrow to expand their operations. And obviously, the higher the interest rates, that tends to be a dampening effect on growth because it just costs more to access those funds. So really what the markets have been concerned about is that the Federal Reserve has indicated that they are looking to raise interest rates. And there's a couple of reasons for that. One is that if we look at what's going on economically, as you've seen from the prior few charts, we've actually had a very nice recovery. We still have people we want to get back to work. We still have businesses who want to continue to be able to have more walk-ins for services and things, but we've again made pretty nice advances from the pandemic lows, and we've gotten many people back in terms of employment and so on. And at the same time, we've had quite high inflation, And while there's a number of factors behind that, the Federal Reserve wants to prevent that inflation from even getting worse and or becoming more permanent. So one way of doing that is by raising interest rates to, sort of slow down or lower the demand level in the economy. So what this chart really shows, either whether you focus on the dots or the blue or the green line, is just how many interest rate increases are expected either by the market or forecast by the Fed itself. And the bottom line of this chart is if you just look at, from 2022 on, the market is expecting the Federal Reserve, because of these factors I mentioned, just to be increasing rates over this year, as well as, a little bit into 2023, and then it's leveling out. So that is one reason why the markets are concerned, because when interest rates go up, it usually does tend to slow down the economy to some extent. And there is also some concern that, is the Fed going to get it right? It's very hard to, fine tune interest rates. And so there's a little concern of, do they overdo it? The other thing I will mention is there's been a lot of talk with what's going on in Ukraine. Would that actually cause the Federal Reserve to maybe back off some of their plans to hike interest rates? And there's two schools of thought. So it's really unclear what's going to happen. One is that, again, because the Ukraine-Russian conflict could cause some more pressures on inflation, the Fed's going to be more incented to actually hike up interest rates to, keep those price pressures under control. The other is because, again, the conflict could have somewhat of a dampener effect on growth, that they're going to be more moderate. So again, we're just going to have to wait and see what happens with which direction the Fed will take that. Next slide, please. Okay. This is just a measure of inflation. In the interest of time, I'll just say they're different measures of inflation, but you see the trend is clear. While, we've had sort of inflation in this up and down, but sort of flat channel over most of the years, what we've seen again since the pandemic occurred is, all of the lines go sharp and up to the right. So this is what we're experiencing today. And again, something that, has been of concern to the market. So another risk factor as to whether some of those factors that are causing inflation to go up will come down, or whether inflation will still stay elevated. Now, I will say that our base case is that inflation will start to moderate throughout 2022 and 2023 as supply chains improve, and as more people and the labor market begins to normalize. But again, we see some risk there, and again, the reason for a more balanced outlook. Next page, please. I just mentioned supply chains. This is another risk factor. It's very hard to predict, how these will normalize. We've obviously never been through something like a pandemic where, people can't, always show up because they're caring for someone with COVID, because they're concerned about, COVID. Where, logistically we can't get goods as quickly around, but we are actually starting to see some signs of supply chain improvement through various measures. This is just one of them. This particular chart shows shipping prices, and what you see again, if you sort of focus on the 2020 on part of the chart, you see we had a big spike up in shipping prices as, again, those supply disruptions occurred and people had to really pay up to ship their goods around. But again, we're starting to see a flattening or coming down of those lines. Next page, please. Finally, I'm going to touch on labor market. This is another concern again, and risk factor. And the big picture with what we've seen with employment and the labor market is, again, there's been a lot of improvement since the lows of 2020. We've put a lot of more people back to work. The average for 2020 was about 550,000 jobs added per month on average in 2021. But I think the question remains, what's that continued progress going to be, as well as what is the percent of people that are going to come back to the labor force? So if you focus on that left-hand chart with kind of the teal line, what you see, this represents labor force participation. So just of all the eligible working people here in the US, the percent of people who are either actively looking for work or working. And what you again see is what happened in the pandemic. Again, if you focus on the most right-hand part of that chart, you see there was a drop off in labor force participation as people exited we're starting to see some improvement, up to, at the end of last year, 61.9% of, um, you know, people are participating in the workforce. But again, that's lower than pre-pandemic, which was 63.3. So we want to continue to see that number improve, because the more people we have in the workforce, the more opportunity for income, and as well as the US economy to grow. Next page, please. And finally, I'll just top it off with COVID case growth as a risk. Obviously, you know, I'm not an epidemiologist, none of my colleagues are, but we are all subject to the effects of what's going on with COVID and how that impacts behavior, as well as actual physical restrictions on work and getting out to spend and use services. So again, this is another risk factor that we'll just need to continue to monitor. Next page, please. Okay, well, that was kind of a quick run through here of the economy, and I'll look forward to any questions that you have that we can help answer as you're thinking through, what's going on in markets, and again, what does that mean for your portfolio, both shorter term and long term. But the other thing that the team asked me to touch on just briefly was careers and career risks. So I'm, again, very privileged to share my personal journey and just a few things that I've learned that I try to keep in mind as I continue to look to how I can contribute to others through the work I do here at US Bank. Next page, please. Let me just share briefly, why I was truly really honored to be asked to speak to you today. And it really comes from my personal story. If you could go back a page. My parents, over, gosh, I guess it was about 40 years ago at this point here, came as or 50, came as immigrants here to the US, and they had the great fortune to be offered some scholarships for higher education, which they are forever grateful for. But my dad in particular is a really telling story, and my mom was in a similar situation. They each came here over as single young students. My dad had $30 in his pocket. That's what he had in a scholarship. And, it was really through, again, the great university education he got here, as well as really friends and mentors, American families who met him when he moved here and really supported him in terms of social connection, inviting him over for dinner, mentoring him and networking with him. I mean, he had, Chinese culture as far as, how to go about getting a job, and really, which can be different than the American approach to it, as well as, even just, social support. And when my parents got married, throwing a small reception for them with tea and cake that, really helped them to celebrate their marriage. And it was really from that and the stories they told me that really made me realize, the importance of networking and mentoring. So again, the really honor to be here as I look at what you ladies do here and Women for Biohealth, and really supporting each other and mentoring each other, because that's how we can all grow and make a bigger difference for our communities. Okay, so what actually has been my career story? It's hard to capture it if you go to the next page in just a few boxes, but I tried to do so here, and I'm just going to hit a few highlights. The first highlight that I want you to hear is, while this is a horizontal progression, it just looks like straight across, right? My career has not been straight across. And what I'd like to share with you is that there's been some ups and downs within it, where I think that has actually caused a lot of my learning. So, just starting from when I first got into the workplace with a company called Russell Investments, was hired on as an investment research analyst, was excited, loved the job, did fine with it over the years, and was promoted up to, director positions of managing, sort of different functions for the company. Several years into career, I had my first child. And at that point, I realized that for me, it was really going to be difficult to keep that work-life balance. At that point, for various reasons, I was working about 70 hours a week and traveling once a month over to London, where half my team was. And I just realized, oh my gosh, this is going to be really hard to give my kid the attention he needs. And so I, at that point, made a pretty radical decision with my husband to take a step back, and I actually tried to quit my position. But I was very fortunate. My company counter offered and said, "We'll take you for anything more than 10 hours a week." And I was like, "Whoa, that's amazing." I had not even asked for part-time because I'd seen several other women in my position ask for part-time positions. And what I had seen is that if they said 30, it ended up being 45 hours a week, right? So they were getting paid three-fourths the pay, but still, working full time. So I just thought, this isn't going to work. So they gave me a really nice opportunity to work for very little time. Basically, I started at 12 hours a week, and they took away all sort of my client facing, which was perfect because when you're on deck for clients, I mean, you can't say today's my day off. You have to help them solve their problems. So ended up working out to be a great opportunity. I went back to research analyst. As my children grew, I was able to step my toes back into the workforce a little bit, worked my way back up to a director position. Lo and behold, the financial crisis comes, and my department that I was running at that point, again, actually, it was new product development, but the company just decided to eliminate it. My Russell at that time had suffered big losses in the great financial crisis from sort of 2007 to 2009, and they just had to have some significant cutbacks. So in one day, they laid off 20% of the company. My team went with it. I was laid off. And, fortunately, after a few months search, I landed a job with a startup company called Altura Capital, where I, again, was back into investment research, but really in a very small, company where, you sort of eat what you cook, right? If we were successful in gaining clients, we got a paycheck. If we weren't, we had to forego. But it was a great experience. I learned a lot by being in a startup and being a jack of all trades, and it did eventually lead to my position here at US Bank, where I head up different kinds of investment research. So, okay, great, Lisa, why did you tell me this story? If you flip to the next page, it really has informed some of what for me are my most important career learnings. So the first one is now going to be self-evident from the story I just told you, which is that healthy careers can move up, down, and sideways. And what I've realized over time is it's not just my story. It's other people's stories as well. So, it's very easy to look at, so-and-so in your company that's a very high up female executive or male executive and say, oh, they probably just always had this straight up career trajectory. But actually, if you sit down and you talk to most of them, what you'll find is that they have also had ups and downs and sideways in their careers, and they've learned a lot from all of that. And that is the mosaic of what makes them, part of why they're successful today. And I'll just tell a brief story. This concept really came to light with me when I sat once on a panel with one of our most senior executives, and she's actually in the process of retiring. So excited for her. But she has been a director of many important initiatives, not only at US Bank, but other financial institutions. And when she went through her career trajectory, I thought, oh my goodness, I had no idea. I just looked at her and was, so impressed with her and thought, wow, she's just always, had the next great position and always been up. And she said, no, there's been times when I've purposely done laterally moves, where I've actually taken a step back, where I've actually had to lay myself off when we've restructured. And it's all been part of my career mosaic. So again, don't be discouraged. Take all of that as part of your package of how you're building your skill set and your learnings. Wisdom comes from all corners. This is a lesson learned from when I have been mentored and mentored others. And what it is that you learn a lot from those who have pioneered ahead of you and had, your new roles and responsibilities ahead of you. But you also learn a lot from maybe people who can be younger in their career. And, one of my favorite illustrations of this particular principle is one of my best friends, who actually I met because she came up to me at a women's event at US Bank and asked me to mentor her. But what I found over the years is, as I mentored her, I learned so much from her because she has a very different personality from me. I tend to be more of a person who's successful because I'm a consensus builder, because I can tackle a difficult problem and figure out how to sort of manage it in a smooth manner. But she tends to be a little bit more of a person who will poke and prod and help people be more innovative. And so I've learned just as much as she has from me. So again, wisdom comes from all corners. Third one is the best style is your own. What I mean from that is I, for many years and even today, still have a little bit of sometimes of an imposter complex, meaning that even though people see me in a certain position at the bank, I always think, oh, again, I'm maybe not as tough as so-and-so who asks these really, difficult questions in meetings and, seem to zero in on things. Again, my strength has been, really building consensus, getting people to work well together, successfully solving problems. But the thing I came to realize a few years ago is actually that's who I am, and I need to embrace it rather than trying to be someone else I'm not. I just need to realize that that's part of my skill set. And while there can be pros and cons to it, just that I need to be who I am, because if I try to pretend to be a different kind of manager than I am, it's just not going to work. So the best style is your own. And then finally, perseverance and faith are your greatest assets. And the reason I say this is it really comes from that time when I was laid off. And as much as, all my friends at Russell assured me that, look, we don't need a new products department anymore, because we've just been through the great financial crisis. It's not you, for an achievement oriented person like me, it really does, for a time really hurt my self-confidence. And I thought there must have been something I did wrong. I wouldn't have been in this position, having to go through a layoff if, I had done something different. But what I learned to do, and this was really with the help of my family and friends, was to put one foot in front of the other day by day. I took advantage of the wonderful resources that Russell offered me when I was laid off. And it was really just, again, through that perseverance and faith, that I, have these great opportunities today to serve clients and prospects such as yourselves and really help them to think about how they can best manage their finances and their investments. So I would encourage you not to give up when you're in the middle of your hard times. And with that, I will turn it over to Megan and Darcy and open it up for questions.
Can you hear me okay?
I can hear you.
Perfect. Thank you so much for sharing everything that you did about the economy and also about your personal story. It's very inspiring. We had an overwhelming amount of questions come in, so I'll try to vet through them, and I'm going to try to separate them and keep some economic and keep some personal, if that's okay.
Sure.
The first question that came in was, can you make a comment around the impact of the stimulus checks on the economy, whether it was negative or positive in your opinion?
Absolutely. So looking back in history, it was absolutely something that was very supportive of the economy at the time. We were looking at an unprecedented situation where we really weren't sure how long the lockdowns would go on, what the impact would be on companies' ability to operate, as well as consumers' ability to spend. And so that, as well as some of the actions that the Federal Reserve took to handle interest rates and support the markets, both really were critical for that very sharp upturn. If you recall, the first graph we showed in 2021 and really helped the economy to recover. I think, it's to be fair, right? It's not all roses. So I think a longer term question that does come is, as we have taken on more debt to support some of these measures, really, again, what is the longer term impact of that? Again, looking back, it's hard to see how it could have been done in any other way, because again, just not knowing the significance and how long the pandemic would last. It makes sense that a lot of these extraordinary measures were taken, but we do have a higher deficit as a result. And so again, I think longer term, these are things that we are all going to have to look at, how we resolve some of these issues.
Thank you. What would be some economic indicators to move a more conservative approach in investment strategies?
Yeah, thanks so much. So really the key thing, well, we're focusing on two real key things right now. So one is the extent of how tight the Fed gets in terms of monetary policy. And again, they're really walking a tightrope because inflation has gone up. The most recent reading that came up on the Fed's preferred inflation measure was 5.2% for January. That's higher than most of us would like. We don't want to see 5%, 2%, inflation ongoing. So they have to try to do what they can to contain price pressures. But on the other hand, if they tighten interest rates too much, it really could negatively impact growth. So just watching the trajectory of what the Fed does and how many interest rates they put in really is going to be key for us as far as our outlook. The second really is, again, inflation and how much that comes down. Again, what we've seen is that with the price pressures, there seems to be some sort of leading indicator signs that those might be coming down. Again, as supply chains resolve and as more people get back into the labor market to get those goods out there and services to meet demand. But again, we're going to have to see. And again, to an earlier question about Ukraine, we're again on the margin that could cause energy prices in particular to be sustained, which is not going to help inflation.
Got it. That would be a good segue into the question of, is there anything you and your team are going to be looking for in the State of the Union tonight?
So, a lot of, I think, what will be addressed tonight is, Biden's thoughts on both what the agenda will be for improving price pressures, as well as, what he may say about security, because again, there's less of a direct economic impact on this point for, security measures, but, just what does that mean in terms of where the United States and other, key nations would be in terms of spending and other things with response to, the security issues that have been heightened in the last couple of weeks. So, those are really some of the key things we're going to want to see. There seems to be in some of the advanced reports sense that he's going to pivot from additional sort of stimulus with what was originally called the Build Back Better package to, again, looking at, again, freeing up some supply chain constraints and stuff. And so we'll see, what are some of the specific prescriptions that he offers.
Thank you for that. Now I think we can switch a little more personal. So as a working parent and going through all of your career path, how did you balance work and life with your family?
Well, thank you so much. For a time I did it through, again, this amazing part-time offer that I had from the company. I realized that was a little bit unusual. That was not something I expected, which is why I didn't ask for it. But I guess one thing I would encourage you is not to be afraid to be creative. So in other words, if there's a particular situation that you need for your balance of work and family, don't be afraid to consider it and think about what's right with your family situation. I have to say, when I decided to initially propose the off-ramp at my career, I thought, okay, if I leave this head position, right, I can't change my mind 2 days later and say I'd like it back again. But I took the plunge, and I think what I've learned over the years, particularly now since companies are more flexible, is that an off ramp at one point in your career isn't permanent. It doesn't mean that you can't come back and do other things. So that's one thing I would suggest. The other thing I would suggest is just self-moderation. So I will confess that given how crazy markets have been and the responsibility that my broader department feels to our clients in terms of helping them with their investments, sometimes the hours can be long. And I asked my boss actually the same question a couple of months ago, and he said, Lisa, you just have to set a stopping time and then just figure out how to get done what has to get done within the stopping time that you've set yourself. And so that's just what I've had to do. And so it is an ongoing learning process for me, but that's my latest trick that I'm trying.
Thank you. I think that's a good trick. 5 o'clock, right?
There you go.
So this one is a typical question. They say, what's the advice you would tell your 25-year-old self?
Advice I would tell my 25-year-old self. So this comes probably more from my upbringing and my heritage. But I grew up with the sort of Chinese overachievement complex, meaning if you weren't a straight A student, a concert pianist, and captain of your soccer team, you weren't successful. So again, my parents were wonderful, but it's Chinese tend to try to overachieve. So I think what I would tell myself is, just do your best every day and remember that life is an adventure, and that even again, when you have those down times or projects that don't go perfectly or sideways, it's a learning opportunity. And again, you know you can't like fail at everything you do, right? Other then you have to realize that maybe it's a different position that might be a better fit for you. But ups and downs are just part of it. And so maybe rather than dwelling on, oh, I could have changed this or that a little bit more to be even more perfect, just I guess enjoying the journey a little bit and seeing what I can learn in each opportunity.
That is good advice. I'm trying to take some notes while you're talking. um, you kind of mentioned mentorship quite a bit, and when you said it was a really big influence in your family, your parents' life when they were coming to America. What would be some of your best mentor advice that was given to you by a mentor?
My best mentor advice. So, one of my most meaningful mentor is someone I still keep in contact with, even though she's retired from the company. And, what she gave me was two things. One is that she always helped me to believe in myself. And again, I mentioned the imposter syndrome, and even though generally I've done just fine, right? I'm always like, what could I've done better, or this part wasn't as good. And she just gave me really helped me to focus on that underlying sense of self confidence. And then the other thing that she really gave me was um, a sense of advocacy. So she was very proactive in introducing me to other people in the company that I could learn from, and speaking about my virtues. So I think many of you are probably familiar with the concept of mentorship versus sponsorship, but she was really the first true sponsor I ever had in the sense of the word. And she meant it all genuinely. When she talked about what I could do, she said it with a real enthusiasm. So I think what I would encourage you is, for those of you who have mentors, to be supportive of each other, to help each other to see, and mentees, the wonderful traits of the other person, how they can continue to build on their strengths, and help them. Even if you're not the president of the company, you can still help others see, if it's natural, the skills of your mentor or mentee partner.
I love those comments. I know I have a mentor at work, and I'm so happy to have one. A last question I think we'll ask is, are there any of your go-to leadership authors, podcasts, or mentors that you would reference others to look at?
That is a good question. Darcy, I'll have to get back to you on that one. There's a book that's coming to mind, but I'm not recalling quite the right title. So let me get the exact right title for it. But what I really love, it's Brene Brown, and I can't think of the title of it, but it's a recent book on tape that I've listened to, and she just has some really good practical advice for again, how you navigate and negotiate different situations, as well as be who you are. So I will find the name and get back to you.
Great. Thank you again so much for your time today, Lisa. I really appreciate it. I want to hand it back to Megan to close us out, as we've got a couple of minutes left.
And
Thank
Darcy,
you.
Oh, and I'm sorry, Megan.
Sorry, go ahead, Lisa.
Let me please just say, I had forgotten before we open this up, the US Bank team had talked to Risa, and if there's any way that we can help you with some follow-on questions or more information, please reach out to Risa and she will reach out to our team here at US Bank and we will make sure we get back to you. So sorry, Megan, please back to you.
No, absolutely. Thank you so much for joining us today, Lisa. I know I learned a lot, and so much of what you talked about today seems very approachable now. So thank you for that. Yeah, and thank you to everybody who was able to attend today. I hope that you all learned something as well. Risa did put her email address in the chat, so if you have any follow-up questions, please reach out to Risa and she'll get in contact with US Bank. And I would just like to put in a final plug. If you're interested in attending more Women in Biohealth activities, please check us out on our website. You'll just want to go to the BioForward website and then find us there. Thanks again, everybody. I hope you have a great rest of your day.